Hey everyone, welcome back to Dollar X Dollar Finance. Today we're diving into 7 core principles you need to understand before you start investing in 2026. But before we begin, a quick disclaimer. Nothing in this podcast is financial advice. It's for educational purposes only. Please do your own research or speak with a licensed advisor before making investment decisions. So, the new year is right around the corner, and you've made a pact with yourself. 2026 is the year you finally start investing. You can already picture it, putting your hard-earned money to work, watching it grow day by day, and building real, lasting wealth. You've seen the headlines about record highs, heard success stories from friends or family, and you want your piece of what is, without question, the most powerful wealth-building tool in history. But hold on. What if I told you that for most beginners, that initial excitement is like being handed the keys to a Formula One car with zero driving lessons? You see the potential, you feel the power, but the most likely outcome is a crash on the very first turn. That's how many people start investing, fueled by hype, confidence, and a dangerous lack of preparation. And for most, it ends in disappointment. Before you even think about downloading a brokerage app or wiring a single dollar, there are 7 core principles you need to understand. These aren't shortcuts or next big stock secrets. They're the fundamentals that separate investors who build life-changing wealth from those who get wiped out by the first market dip. So let's break them down. First things first, how do you actually enter the investing world without getting burned? The first principle is simple but powerful. It's not only fine, but smart to start small. So many people freeze because they think they need $10,000 or $20,000 before they can begin. They wait, and in the process, they lose their most valuable asset, which is time building. Wealth is a habit, like going to the gym. You don't start by trying to bench press 300 pounds. You start with the bar. In investing, your first contribution could be $50 or even less, and if your strategy is dollar cost averaging, starting small actually suits you best. You're investing a fixed amount regularly, regardless of whether the market is up or down. That steady rhythm helps you smooth out volatility and grow your wealth gradually, brick by brick. The best part? Many modern brokerage platforms now support fractional investing and minimums as low as $1. For example, platforms like Robinhood allow you to start small and invest automatically on a schedule. What matters isn't the size of your first investment, it's the consistency behind it. Think of it like laying bricks. One brick looks like nothing, but keep adding, month after month. Soon, you've built a wall. Keep going for years, and you've built a fortress. Now, let's talk about the second principle, which is ETFs beat individual stocks every time. An ETF, or exchange-traded fund, is one of the greatest tools ever created for everyday investors. Picking stocks is like guessing a cake recipe from scratch, trying to figure out the perfect mix of flour, sugar, and eggs. Your chances of getting it right are tiny. An ETF is like a professionally made cake mix. It already contains hundreds or even thousands of companies, a perfectly balanced blend. So, instead of trying to find the one winning company, you own a small piece of the entire market. An S&P 500 ETF, for example, gives you exposure to 500 of the largest and strongest businesses in America. That's called diversification, and it's your best defense against risk. And here's something most beginners don't realize. Even professional fund managers can't beat the market consistently. According to S&P Global's Espiva report, 91.03% of actively managed funds underperformed the S&P 500 index over the past 20 years. That means 9 out of 10 professionals, people paid full-time to pick stocks, still failed to beat a simple, low-cost S&P 500 ETF. So for beginners, the smartest move isn't to try to outsmart the market. It's to own the market. That's the quiet, reliable path to long-term growth. The third principle is, if you buy individual stocks, buy blue chips, not hype. Blue chip companies are the big, stable, proven names that have weathered wars, recessions, and market crashes. They're not always exciting, but they're dependable. Meme stocks, on the other hand, are the complete opposite. Their prices move on emotion, social media buzz, and fear of missing out. That's not investing, that's gambling. You're betting that you can sell your shares to someone even more hyped up than you are before the crash. You might get lucky once or twice, but over time, the odds catch up. A perfect example came from 2021 when Cathie Wood's ARK Innovation ETF invested heavily in trendy, high-growth names such as Teladoc Health and Zoom Video Communications. At the time, they were market darlings. Everyone was talking about them. But since their peaks in 2021, both stocks have lost over 90% of their market value. That's what happens when you chase hype instead of fundamentals. Meanwhile, great companies with strong balance sheets, like Nvidia and Microsoft, weathered the 2022 downturn and came roaring back, reaching new highs by 2024 and 2025. That's the difference between speculation and quality. True investing means owning a real, profitable business, not a passing trend on Reddit. The first three principles are about how to start. The next two principles are more focused on investors' mindset. They are critical because investing success is 80% psychology. So fourth principle is investing is a marathon, not a sprint. You are not trying to get rich by next Tuesday. You're building wealth slowly, steadily, over years, maybe decades. Historically, the stock market has returned about 10% a year on average. But that doesn't mean it goes up 10% every year. Some years it soars 30%, other years it crashes 20%. Your job is to stay in the race. Think of it like a long-haul flight from New York to Singapore. You know the destination, but there will be turbulence. When the plane shakes, the amateur grabs a parachute and jumps. The experienced traveler tightens the seatbelt and stays calm, knowing turbulence always passes. The market is the same. Stay on the plane. The destination, long-term growth, doesn't change. And here's a perfect example of what that mindset looks like in numbers. If you had invested just $10 a day since March 2009, that's a total of about $41,910 contributed over roughly 16 and a half years. By October 2025, that same steady $10 a day approach would have grown to around $163,000 in the S&P 500, or an incredible $268,000 in the NASDAQ 100 QQQ. That's the power of time, compounding, and consistency, not timing. Even small, steady investments can lead to life-changing results over the long run. Fifth principle is embrace volatility. This is where most beginners fail. The market never moves in a straight line. Even the biggest, safest-looking companies can drop 30 to 50%. Just ask anyone who owned big tech in 2022. Volatility is not a bug. It's the cost of entry. It's the price you pay for the reward of long-term growth. Here's the mindset shift. When the market falls, don't panic. See it as a sale. A temporary drop doesn't destroy your wealth. Selling in fear does. Those who stay invested through downturns are the ones who enjoy the massive gains that follow. If this is helping you think differently about investing in 2026, please tap the like button. It really helps more people find the channel. And if you want to keep building your financial IQ, make sure to subscribe so you don't miss what's coming next. All right, let's finish strong with the final rules that protect your portfolio. Sixth principle, use tools to track your progress wisely. That doesn't mean refreshing your portfolio 10 times a day. That's a shortcut to anxiety. Instead, schedule calm, periodic check-ins, maybe once a quarter. Review your performance, rebalance if needed, and adjust your contributions. Learn some basic Excel formulas like XLOOKUP, CAGR, or percentage change. Tracking your own data keeps you grounded and teaches you how compounding really works. It turns investing from a guessing game into a learning process. And if spreadsheets aren't your thing, that's okay. Many stock and brokerage platforms now provide clear visual charts showing your accumulated contributions and profits over time. These line charts are great for spotting trends, understanding your growth path, and reminding yourself how far you've come. The key is to stay informed without getting obsessed. Last but not the least, and maybe the most important rule, avoid leverage. Leverage means borrowing money to invest. It's often pitched as a way to amplify your returns. And it does, but it also amplifies your losses just as fast. Imagine you have $1,000 of your own money. You borrow another $1,000, so you invest a total of $2,000. If the market goes up 10%, your portfolio becomes $2,200. You pay back the loan and keep $1,200, a 20% gain. Sounds incredible, right? But now flip it. If the market drops 10%, that $2,000 becomes $1,800. You still owe the $1,000 you borrowed. You pay it back, and you're left with just $800, a 20% loss. Now imagine a 50% crash. Your $2,000 falls to $1,000. You pay back the loan, and you're left with zero. That's not a temporary dip. That's a complete wipeout. This is why beginners should avoid leveraged ETFs and margin trading entirely. These products are designed for short-term traders who can afford to lose big, not for long-term investors building wealth slowly and safely. Here are some real-world examples, and the numbers speak for themselves. TQQQ, the 3 times leveraged version of QQQ, plunged more than 80% in 2022 when tech stocks corrected. Regular QQQ dropped, yes, but TQQQ got obliterated. And it's not just the long side. Earlier this year, Granite Shares 3 times inverse AMD ETF, the leveraged product that bets against AMD, got completely destroyed when AMD's stock surged 38% in a single session. That one-day move was enough to essentially kill the entire ETF. These extreme examples show exactly why leverage looks tempting until it blows up. For beginners, and honestly, for most people, leverage isn't a shortcut. It's a trap. Avoid leveraged ETFs. Avoid margin. Stick to long-term investing, not gambling with borrowed money. Now that all 7 principles have been discussed, let's wrap them up before investing a single dollar in 2026. Number 1. Start small. Consistency is king. Number 2. ETFs over single stocks. Own the whole market. Number 3. Choose blue chips, not meme stocks. Number 4. Investing is a marathon, not a sprint. Number 5. Embrace volatility. Even great stocks fall. Number 6. Use tools like Excel and brokerage platforms to track and learn. Number 7. Avoid leverage. It magnifies losses and wipes out beginners. This isn't get-rich-quick advice. This is get wealthy slowly and sustainably advice, the kind that's worked for generations. Once you've built that foundation, the next steps are straightforward. Open a tax-advantaged account like a Roth IRA. Pick a low-cost, diversified ETF. Automate your contributions every month and let compounding handle the rest. Real investing success isn't about luck or adrenaline. It's about discipline, patience, and time. If you start 2026 with those 7 ingredients, your future self will thank you. Thanks for spending your time with me today. This is $X Finance. I'll see you in the next episode.